So to get this session underway, we're going to have a presentation of a white paper produced by the Asian Development Bank, Trade and Supply Chain Finance on deep tier financing. And to present that, we have my great colleagues here. We have Carmen and Aparna. And to get underway, Aparna, over to you. Thank you. And you might need the mic. Oh, you have it, mic, yeah.
Thank you, Vin. And good morning, everyone. When I left Mumbai over the weekend, I thought I've left all the rains behind. And I'm so happy to see some sun popping up on this wonderful day here today at GTR, Singapore. Welcome, ladies and gentlemen. I'm Aparna Soni from ADB's Trade and Supply Chain Finance team.
And I'm Carmen Ramirez, also from ADB's Trade and Supply Chain Finance program. So we are here today to present our paper on findings on deep tier supply chain finance, which will be followed by an exceptional panel discussion on the same. So financing SMEs, together with sustainability and ESG related consideration, continue to play a critical role as trade and supply chains evolve post-COVID. As per latest ADB estimates, but this doesn't want to work, okay. As per latest ADB estimate, the trade finance gap has likely grown to at least $2 trillion. The negative impact continues to be felt most acutely by SMEs, especially those in emerging markets, which were also the most dramatically impacted by COVID-19. While supply chain finance has been considered so far as a good solution to enable access to financing to SME suppliers, the reality only reaches the tier 1 supplier. However, as we all know, most global supply chains involve thousands of suppliers. This is particularly important for some key sectors, such as constructions, automobile, or electronics. In these global supply chains, SMEs are often concentrated at the end of a long, far-reaching tail of suppliers, and normally those in more needs of financing are the least likely to have access to it. Therefore, supply chain finance needs to be upgraded and adapted to be able to meet needs and current complexities of global supply chains. This solution shall facilitate access to financing to tiers beyond tier 1 and also help address some sustainability and ESG related challenges in supply chains.
Ladies and gentlemen, that brings us to a big question. Is there a solution available? Carmen, what do you think?
So this is actually what our paper covers. The one innovative solution that can address this challenge is deep tier supply chain finance. DTSCF evolves from payable finance with capability to channeling financing working capital loan beyond tier 1, so to suppliers in tier 2, 3, and 4, smaller suppliers. Beyond the financing aspect, DTSCF platform connects the anchor with its ecosystem as its suppliers onboard their own suppliers, and this brings transparency across the supply chain and across the flow of capital. So this enhanced visibility enables monitoring, but also incentivization of sustainable or ESG-aligned behaviors. Moreover, the technology that enables DTSCF can be used to transmit scores, standards, or other ESG-related data throughout complex supply chains.
Therefore, the power of DTSCF lies in its inclusiveness. It enables large corporates to make their supply chain resilient, transparent, and visible. Buyers can identify and address the vulnerabilities throughout the chain, and they can also demonstrate sustainable ESG goals to their shareholders as well as end customers. The entire supply chain can be better positioned to respond credibly to increasing government regulations. For example, proposed EU regulation, which requires EU buyers to are able to audit and monitor their entire value chain for ESG compliance.
But Aparna, so far we have been talking about capabilities and benefit of global supply chain, deep tier supply chain finance, but now we need to know how it works, right?
Absolutely, Carmen. So like traditional supply chain finance, DTSCF also leverages on the relationship between anchor corporate buyer and tier 1 supplier. But there is a key differentiation. It reaches down the further suppliers through a distribution of financing mechanism which is integrated into its structure. McKinsey estimates that the annual supply chain volume is close to $38 billion, with an annual growth of 38% in 2021. I'm sorry, it's $17 trillion volume and with a growth rate of 38%. And this is the opportunity which DTSCF has. Unlike the traditional payable finance, which you can see on my left side, which focuses only on the anchor corporate buyer and tier 1 supplier, deep tier financing actually moves on through the platform. The approach is based on a platform which can then digitally connect the suppliers down the value chain. This distribution mechanism works through issuance of a payment commitment between anchor corporate buyer and tier 1 supplier. This payment commitment, which is also called as digital payment obligation, that is DPO, is split and then further transferred down the line on the request of suppliers. And this is where DTSCF unlocks its capability. That is when a supplier enables access to finance to its supplier down the line through DPO rather than encashing it at its own level.
So this actually sounds like a workable model, right? At least in theory. So I'm sure everyone in this room will have one key question, which is it practical? Has it already been implemented? So there are some fintechs and few banks that have already been successful at developing some workable solutions, especially in People's Republic of China. Moreover, in recent years, some of these fintechs have been able also to expand these solutions across borders. And we have actually covered these solutions in our paper. However, it must be noted that the current models are the result of unique innovation from fintechs and banks. So therefore, the ability to effectively serve cross-border global supply chains and address the trade finance gap really depends on standardization and scalability of enforceable solutions. So now the key question is, for you, Aparna, deep tier supply chain finance has been proven to be a valuable solution for global supply chains. So what is really preventing its global scalability?
I can actually summarize into 3 key challenges: legal framework, adoption, and technology. Let's address them one by one. Starting with legal framework. Currently, there is a lack of agreement on legal aspects of the structure, which presents the most challenging barrier for adoption across borders. The structure of DTSCF and the underlying payment obligation of the buyer is not clear, and thus there is different methods of adoption from player to player and market to market. Though the traditional instrument can serve the purpose of further dividing and transferring the payment obligations, the digital nature of this entire structure currently lacks enabling legislation, and that is one of the important key for jurisdictions to adopt. KYC, of course, remains a challenge, as it has been in other financing solutions too.
On the second barrier, there is limited awareness of deep tier supply chain finance, but also limited capacity to advance education at such a scale. Resistance also from SMEs to participate in those programs, often due to concerns about commercial confidentiality and data security, continue to be a concern and a persistent challenge for deep tier. From a technology point of view, we have identified 2 key issues. The first one is the degree of technology adoption, with some SME suppliers, especially those in emerging markets, having limited or no access to digital means. Also, integration challenges, because the full integration of the platform, the DTSCF platform, with all trade ecosystem, with all the participants of the anchor, is key for success. However, there are multiple types of platform, and the lack of familiarity with these technologies together with with the time consumed to integrate and cost associated, it's a key challenge. But also, we have to emphasize that while technology leads to some key challenges, it's also an enabler for innovation, especially deep-tier supply chain finance.
I'm sure everyone sitting here is thinking, Carmen, that there are so many moving parts. Will that make scaling DTSCF a big challenge? I think it is, but it is not an impossible one. None of these challenges, we need to remember, can be resolved by an individual stakeholders. What we need is a collaborating effort by various stakeholders, by governments, central regulatory authorities, MDBs, financial institutions, buyers, suppliers, and fintech companies to come together. Certain aspects are already being addressed in few jurisdictions where DTSCF has actually seen a pickup, like, for example, People's Republic of China. But a common framework and tailored incentives and support is required to make it work across the jurisdictions. It is also key for these solutions to address some pain points of suppliers, especially the ones Carmen mentioned regarding the visibility of key commercial information and technology integration, as well as incentive of adoption by integrating ESG-related solutions.
So, ladies and gentlemen, we have now gone through models, the challenges and the potential solutions, what we want to call it call to action. And now we come to our last slide. So we have seen that this is indeed an opportunity for everyone, but also it's a responsibility for all trade ecosystem participants to help advance innovation like deep-tier supply chain finance. Innovation that will help support green, resilient, and sustainable trade and global supply chains.
DTSCF actually offers opportunity to couple financing support to SMEs with enhanced resiliency, transparency, and visibility across the most complex and far-reaching supply chains. Such visibility also contributes to ESG goals, which need support of entire supply chain participants. With that, ladies and gentlemen, I would like to conclude here with a quote from Peter Drucker. What gets measured gets improved, and this is the tool to track and measure and build in solutions for improvement. Carmen, over to you.
Thank you, Aparna. So, ladies and gentlemen, this is the end of our presentation. The detailed paper will be published on our website very shortly, next week. And we are now delighted to have our amazing panel of discussion to get some light on it.
So Aparna, Carmen, could we give them a big round of applause for a wonderful presentation? And now Stephen Beck is going to moderate a panel to discuss this in more detail. But you know, there's a key message here. And number one is where there is growth, it's driven by SMEs in the world economy right now. That's a fact. The second thing is when we're looking at trade finance, really when we boil it down, there are two key requirements, and that is liquidity, money, and risk. So if we can find a mechanism that advances the ability for a buyer with which we have a credit appetite to take risk for sub-buyers, if we can implement that as outlined in the white paper, I think we'll be making a big step forward. Stephen, over to you.
Thanks very much, Vin. Guys, thanks very much for the presentation. It was great. Just one point of clarification, please. When you were explaining how deep tier works, there was one thing you mentioned I thought would be helpful to get some clarification. The model works through digital payment obligation rather than encashment of the digital payment obligation at its own level. What did you mean by that, please?
Let's maybe get back. Wait, sorry, I don't have my. Well, nice. Let's get back to this one. Aparna, you want to?
Sure. So, Stephen, if the supplier avails financing against the DPO gets extinguished at that supplier level, and there will be nothing left to pass on to the other suppliers. And that's exactly why it is key that DPO keeps getting transferred. However, the supplier needs still get met because the requirement for supplier for financing is to fund its further supplier. By passing on the DPO, it is actually meeting the need further down the line. And that's exactly how this structure works.
Thanks very much. Thanks so much, guys.
Thank you, Stephen.
Thank you, everyone.
Thank you, everyone.
So now to discuss this, the paper and further to the presentation, I have a fantastic panel. What we're going to do is we're going to start with some introductions. Then we're going to talk about opportunities and then the challenges. And then we're going to try to come up with some solutions on how we can overcome these challenges. And we'd actually welcome the participation of everyone in this room. But of course, because as we know, overcoming these kind of challenges in the industry requires partnerships. Michael, let's start with you. Michael Surrigan, MD, StanChart, Open Account Trade. You guys are a powerhouse in emerging markets. Please, in 60 seconds, can you tell us high level what you guys are doing in deep tier?
Absolutely. Thanks, and great to be on stage and great to get connected here after 3 years absent from any in-person sessions. So we've been dabbling in the deep tier financing space for a while now, a good 4 years, and what started out as a very sort of proof of concept, a few pilots, has really scaled massively for us. Just a few numbers. At this point, we run close to 30 different programs. Close to 1,000 suppliers have been onboarded. On average, we have about 250 million of assets with more than 1 billion of deep tier supply chains that we have financed. So very exciting space, very much focused in domestic China right now, but we are keen to expand this into international corridors.
Oh, that sounds great. I was talking with Kai, like, I don't know, 6 months ago or something like that, and he was saying that you guys are involved in some deep tier transactions that go like 11 tiers down into the supply chain. So that's really extremely interesting. And any high-level takeaways, Michael, from this white paper? Anything that you find sort of surprising or not surprising?
No, I think it's a real good read in terms of really understanding the landscape, the way it stands today. But I would say at this point it's still fairly fluid. I would compare Todd like supply chain 20 years ago, where lots of sort of new entrants, new players, everyone's trying to do supply chain. That's why what characters right now deep tier. There's 3 different models that you guys are depicting: the IPU, the Digipo, right, or the LT element. But I think there's going to be more models that probably will evolve over time. It'll be interesting to see what and how these different models will scale. And I think what is also challenging with this is different. I think the paper touches upon that, with the legal environment and in regards to the enforceability, how these different models will be more pervasive.
Indeed. Well, that's a good segue to introduce Angie Chia, partner at Mayer Brown, legal eagle. I don't know if you guys, many of you have maybe had the opportunity to work with Angie, an incredible legal mind, always able to sort of identify the issues, work to find solutions and mutual gains. So, Angie, what do you have to say?
Thank you very much for that very, very kind introduction. Good morning to everybody. I feel under a lot of stress right now. There seems to be so much hinging on the legal framework. So basically, my background is I've been doing trade finance for decades now. The interest in deep tier actually stemmed from a conversation that Sunil and I had a few years ago in a room in ADB when we were drawing on the whiteboard and saying, what if we could do this? What if we could do that? What if we could? And it's like, wow, it would be fantastic. Because if we could actually serve the SME segment, which has been so severely underserved, it is massive in size. It impacts the world in such a magnificent way. If we can get all the financing to that, employment up in various countries, it is something that's very, very close to my heart. So I'm very, very happy to work on this project. And you know what? I think we can really solve the issues. These challenges are not insurmountable, and we'll get to it.
Indeed. Thanks, Angie.
That point there has been, indelibly scribbled onto ADB because we were using a permanent marker.
Raja Debnath, co-founder VFin, an emerging player in this space, being watched by a lot of people. Please give us the 60-second high level on what you guys are doing in deep tier, please.
So our interest in deep tier started a few years back when I was at IFC. And it was all related not with supply chain financing, but about SME financing. That how do you actually solve the access to finance problem? And that's when we started dabbling in this. And I moved out of IFC, we started VFin. VFin is a supply chain finance technology platform who provides technology solutions to various banks and NBFCs globally. So on deep tier, we are doing a couple of POCs right now in India. And touching on what Michael was saying, the legal aspects, every jurisdiction has a different challenge in terms of the legal. Trying to find a global platform, a global commonality, I think we're still quite far away from that. And we'll be touching on deep tier and whatever we are doing at a local market level. And there's a lot of interest. And I think this crowd in this room shows that there's tons of interest that we're finding from banks globally in terms of how they can get into deep tier financing. Primarily because there's a lot of pressure from the regulators also in terms of contribution of their SME financing to their balance sheets. So this is a great way of using good quality credit and financing SMEs. And something very interesting about the paper.
Yeah.
If you actually go and do search on deep tier financing on the net, there isn't a lot of material. And I think this ADB paper brings that very well together. I think this will become the standard for anybody in the industry wanting to learn about deep tier financing. So this is the most voluminous tome, as one could call, on deep tier financing. And interesting part is what Michael said, that SCB, for example, has been doing this for the last 4 years. But still there's not enough material out there. People don't know what's happening on deep tier. So I think today's panel is going to be interesting for the people here.
Thanks, Raja. Todd Burwell, I think very well known in the industry, the contribution that you and BAFT, Bankers Association Finance and Trade, have made, including to reduce global trade finance gaps, especially through the Master Risk Participation Agreement that probably all of us in this room use, is really incredible. Todd, thanks for joining us. Any high-level thoughts you want to share on the
Sure, I've always got thoughts. But I think in the intro there was reference to the fact that in order to move this forward, it's going to require a great deal of collaboration between banks, other financiers, fintech companies, regulators, policymakers, which is what we do. That's why we exist. It was interesting to me also just thinking about the nature of deep tier. It struck me originally as this looks like traditional supply chain finance with a technology kicker. But the real interesting part of this is in the weeds, right? And when you get down into the weeds, that's where we start to touch on the legal issues and some of the KYC and other issues and so forth. We've spent the better part of the last 2 years working with the two accounting standards bodies, trying to get them up to speed on what is supply chain finance and how should they look at it from a regulatory perspective. I think we have largely steered them clear of treating this as debt on the balance sheet, but there's clearly an interest in more disclosure. So I couldn't help but when I read this paper thinking, you know, the question of disclosure and visibility and transparency and all of that is going to be of big interest to that community, to the investor community. And then the more slippery slide of that slope, I couldn't help but think about the creative packaging that some may be tempted to push this to, right? And once you start to get down to lower levels of the supply chain, you know, we can't afford what happened in 2008 with mortgages to happen with supply chain finance. So we're going to need to discipline ourselves around how we roll this out. Otherwise, we could find ourselves in trouble.
Yeah, well, we're a long way away from that, but hopefully, well, I was going to say, hopefully we get there. Hopefully we find the right balance. And my colleague, Sunil Mascarenas, doing an awesome job scaling our supply chain finance business. Any high-level thoughts, 60 seconds on the paper?
Well, you know, I'd like to touch on some of the shortcomings of the popular payable finance product, to be honest. And someone mentioned statist, I think it was Aparna, who said $1.7 trillion in 2021 with an addressable market of about $17 trillion. But really, in terms of the use case of the product itself, which was to finance SMEs in the first tier of the supply chain of large corporates, that's where the product is possibly falling short today because the SMEs over the years have really graduated away from the first tier and are now in the deeper tiers. So that's where the payable finance product actually, fails to address the use case that it was built for today. DTSCF very strongly comes as a product or intervention which can attack or address the SMEs which are lower down the chain and can go actually to the farmhead in many cases to finance those, and therefore can be used, and I think we touched on it in the paper as well, the behavioral aspects of supply chains. In terms of how do you incentivize the supply chain to move towards an objective. Today's objective could be ESG, tomorrow it could be something else. How do you incentivize the supply chain, the entire supply chain to move through? And also the impact that a product like this could have on the cost of goods sold at the anchor buyer level, because it makes the entire supply chain efficient in terms of bank financing rates.
Mm-hmm. Yeah, indeed. Well, one of the takeaways for me was that, I'm sure everyone in the room feels this way, that hopefully post-pandemic, the responsibility for all of us, not just to sort of close these trade finance gaps, provide financing to companies to support trade, is there, but now we're expected to do that in such a way that we're able to ensure that the entire supply chain is compliant with environmental standards, social standards, and so on. It's daunting, isn't it? And the thing that really struck me about this study is the link that was made between deep tier supply chain finance and our ability to address these issues on sustainability, labor standards, and that kind of stuff. So I thought that was fascinating. And then the second bit that's, I guess, related is just the power of driving transparency throughout the supply chain, combined with the sort of data flow that you can get from that and what you can do. So I think, all of us have the ability to have such a profound impact on these big sort of questions that we're grappling with through this kind of a product. So that blew me away. So guys, just in terms of the opportunities, whether it's macro, like the big sort of societal stuff, or micro, in terms of where financial institutions or companies can benefit, where do you see the opportunities?
Can I pick that question up?
Yeah.
So it's really, really timely to talk about D-tier SEF, which ties in very well with the legislative perspective. So in the EU, we know that they passed this directive on corporate sustainability due diligence. So the proposal was adopted in February of this year. What the directive requires is that larger companies diligence not only their own company's operations, but those of their subsidiaries, but more importantly, operations of their, and I quote, direct and indirect established business relationships. So this would include their global value chain beyond the tier 1 supplier. So what does the directive actually require? It imposes a duty on large corporates to, amongst other things, identify actual or potential adverse human rights and environmental impacts, prevent or mitigate potential impacts, bring to an end or minimize actual impacts. So this means a more comprehensive, effective compliance with international conventions such as the Universal Declaration of Human Rights, the Convention on Rights of the Child, the International Labour Organization's Declarations on Fundamental Principles and Rights at Work, the Paris Agreement, the 1992 Convention on Biological Diversity, just to name a few.
Wow, that all sounds so easy. Thank you. I quit.
So these conventions have over 170 signatories each. They're widely adopted. Now, personally, I can see how tying access to finance would be a powerful incentive to motivate company suppliers to prevent, mitigate, or end adverse human rights or environmental impact. Another thing that's worthy of mention is that the legislation will have bite, in that national supervisory authorities have the ability to impose fines, and victims can actually take legal action for damages. So France has already passed the Duty of Vigilance Act in 2017. Germany will pass the Supply Chain it has passed the Supply Chain Due Diligence Act, which will take effect on the 1st of Jan 2023. Norway will be passing their legislation soon. In total, this directive will impact 13,000 EU companies and 4,000 non-EU companies that are operating in the EU. So in my personal view, the impediments to deep tier SEF, from reluctance to disclose information, Todd, your point about transparency, will be chipped away by these kinds of regulations. Additionally, is it possible that other jurisdictions may implement similar legislations? Yes, if we agree that these legislations are enhancing the effective compliance with international conventions that we're all party.
Yeah. Well, it's daunting, isn't it? I mean, to be able to comply with all of that. And you mentioned the number of companies that need to comply in Europe, but what about the suppliers in Asia, for example, to those European companies?
They will have to disclose the information if they're actually supplying to these EU companies,
Yeah.
and the EU companies will go. And to Michael's point when he was doing the economists, right? The supply chains, they're all pretty much in Asia, so that compliance is just going to drive through.
So, and how are we going to be able to do that without deep tier supply chain finance? As
Stephen,
the
may I
model?
just add to that, right? So I think that's the European landscape, but we see it in China specifically. There's specific regs out that enable and support the funding and financing of supply chains, SMEs and all that, which really enabled for us the deployment of this deep tier capability in China itself, right? And if you connect some of these regulatory frameworks together, right, there's a huge opportunity, right? I think, Sunil, you spoke about the shortcomings of payable financing. Clearly, I think we have a lot of bankers in this room, right? The average utilization of most payable finance structures is, what, 60% at best, right? The remaining 40% don't need funding. That means that funding or that capacity could be deployed in that next tier, right? We have many examples, right? We have this client that really started this co-creation journey with us, Skyworth, which is a consumer electronics manufacturer in China, right? They had a very complex supply chain, 9 different buying entities. I mean, you think about any TV has more than 1,000 spare parts, right? And we've been able to your example earlier, go down to the 11th tier, provide funding to the smallest SME there, because that's where they need funding the most. And that, I think there's a great manifestation in terms of how you really link capabilities of digital, some of these regulatory frameworks really enable this type of funding financing, and really bring in that sustainability element. I think the element of transparency is really a huge opportunity. We didn't have that in the past. For payable financing, all we take in is a approved payable file, but that's really just a starting point. Here, with deep tier, we're getting a lot more deeper visibility with regards to where funding and financing is needed. If there's anything you learned in the pandemic, right, we all need more visibility and we need more transparency. And I think that's a huge opportunity here to marry all that together.
And that particular visibility on a transaction, what it does is, we talk about payables finance, the DTSCF, by making the transaction flows visible down to the 11th layer, if you will, has the potential of actually enabling banks to penetrate products which are currently sold at tier 1, which is like pre-shipment products. Because you get visibility, even the nth layer can technically be financed with a pre-shipment so that you are financing a more significant part of the working capital cycle. So that's what the power of the whole product is in terms of the visibility itself.
So there's one more view around this entire visibility angle. So as long as we're talking of international global supply chains, visibility and the power of the large corporate and the large anchors in those European markets allows and can mandate that level of visibility. Now, when you start looking at a domestic market or domestic supply chains, that's where, at least in Asia, you will find there's a big reluctance of the tier 1 suppliers to give visibility to their anchors on their supply chains. So this entire concept of visibility itself sometimes is the impediment for actually doing deep tier financing. So we actually also therefore need structures which can do deep tier financing without the requirement of that visibility. So like we have at the payable financing level. So the model that we use at BFIN is exactly that, where you do not require visibility of the contents of the invoices right down the various tiers, and you just look at the amounts and the dates. Because suppliers are that much more comfortable in sharing that information, but not anything beyond that. And again, ESG. ESG is a very big topic spoken in the bank boards and in various multinational banks. But when you start going to the domestic banks, ESG is still catching on. So ESG may not be the route through which you will actually push a deep tier supply chain finance. It's more for a banker and what is in it for me, how soon can I get the volumes in. And I think that's where more and more examples of what's happening in the deep tier world and actually translating that potential into actual numbers will actually make bankers, even my bankers in this room, wake up and say, there's an opportunity for me to get additional volume. So deep tier at a base level can be just seen as, this is a great way for us to get additional volumes at better rates than what I'm actually doing payable financing at the tier 1 level.
So if I can, I want to challenge that point on visibility a little bit. Two things I think about with visibility and digitization. One, if in my opinion, if you can solve the sort of digital onboarding process for supply chain finance, it's a game changer, full stop. It changes the economic model for providers to offer this. But when I think about visibility, I think about e-commerce, right? And how having visibility to e-commerce buyers and sellers on a platform have allowed for e-commerce platform providers to start to enter into the finance space, as well as I look at some of the logistics providers who have visibility into freight moving from point to point to point, and that has encouraged them to enter the finance space. I think we could find ourselves with more capital chasing companies that need it, and that in itself could also be a game changer, but that will require visibility.
Let me just add to what Todd was just saying. I think part of the reason why we're so early, so successful, because of our collaboration with a local platform, LinkLogis in China, right? There's that element around local knowledge, domain knowledge that this company had. I don't think we would have been able to scale so quickly if we would try to build this ourselves, right? And to your point, absolutely, the ability to onboard takes a few minutes to onboard a single supplier, all the way from local registry checks to AR registration is done within seconds. I mean, that is the ability where that's the opportunity, right, and be able to scale if you really collaborate. And that's probably the difference when I think about how we started supply chain way back in the days, where a lot of that was done, directed primarily through banks. And here is really an opportunity for far better collaboration, and we're seeing how that can be done on a real good scale.
So no question that there are a lot of opportunities with the deep tier supply chain finance, and more than that, maybe it's going to help us address, our increasing obligations around sustainability, labor standards, ensuring all of that throughout the supply chain. So let's move now to the challenges. The paper identified sort of 3 categories of challenges, right? So the one had to do with limited understanding and awareness in the market, but I think it was referred to as adoption up there. It would be interesting to delve a little bit more into that, or not. Anyway, the second one is legal issues. The third one is tech. So should we bother talking about the adoption bit and the market understanding if we haven't resolved the legal issues and the tech? I mean, well, then what's the point, right? You sort of market something that by and large we're not able to do in most markets. Isn't it better to just sort of wait until we, address the legal and the tech, and then when it's ready to go, then you start, promoting it? Just sort of 30 seconds. Would you agree with that or not?
No.
Oh.
No.
Things are good. Okay. Well, tell me why. Why would you disagree
So
with that?
I think you start with what's worked, and then you work from there, right? You say, what were the key ingredients to make it work in whatever market it's working in, and how do we scale it? And then we go from there.
Well, I agree with that, but the way I understood this adoption bit was that you actually go out to companies and explain that this is something that they should that they should embrace. But if it's not ready to be embraced because the legals and the tech aren't sorted, then aren't you sort of blowing your opportunity to peddle this when, you know, in the future, after we've solved the legal and the tech, that's when we really want to, no?
Yeah, I guess I would start with Michael, right? And I would say, you've got a story to tell. Somebody has utilized a solution that you guys have come up with, and they benefit from it. Yeah. If you tell that story to someone else, I'm sure they'd say, hey, I'm interested, tell me more. And then I think you tackle the legal issues and other issues as they come up in the course of that conversation.
So Stephen, if the demand doesn't exist, for example, so nobody will bother to get around to solving the legal issues. I mean, tech is doing a fantastic job today in doing all those pilots and showcasing the stuff in terms of how it works. But if we can't get the large buyers interested, either by legislation or indeed by a commercialization case, the legal aspects will not be taken up. Angie?
I agree. I mean, there's no denying globally we do have different laws in each jurisdiction. Laws operate in different ways everywhere. DTSF models that work in one jurisdiction, like do in China, may not necessarily work as well in another jurisdiction on a cross-border basis. And bearing in mind that these do use platforms and it's very electronic, we do have differences, right? So are electronic signatures, electronic data, electronic trade instruments recognized and treated the same way globally? No. KYC, AML issues, again, no. But that doesn't mean we can't resolve these differences. So in the short term, I think in terms of DTSF for China, you can use a set of common terms to address the unique aspects of DTSF. Works fine if you're in one jurisdiction. And in terms of KYC, AML, we fixed the problem before. The Wolfsburg Group did actually provide a lot of guidance with the trade finance principles. And so we got a lot of clarity and things moved forward a lot faster in the KYC, AML space because it was socialized well with the regulators. Now, in the longer term, we can actually adopt a similar approach to UCP, Uniform Customs and Practice for Documentary Credit. What UCP does is it's established a standard set of contractual terms that are incorporated by reference into relevant contracts created between various parties in a letter of credit transaction. Now, this approach can also be applied to deep tier SEF, where there are multiple relationships that are related yet separate. It is relevant to note that the adoption of UCP coincided with an uptick in global trade. As we've always said, right, trade is facilitated by standardization. So if we can get that in place, that's something that will really. From a legislative perspective, there's been the adoption of model laws drafted by UNCITRAL, and these have been, in some instances, adopted very widely globally. Now, we can consider the adoption of model laws in respect of deep tier SEF, but it'll take a bit of a longer time. Okay? The issues, as I said, are not insurmountable. We just need a little bit more consideration.
I think the legal aspects, so the market awareness comes, I think, second. It's the first is the legal aspects. Because the moment you start speaking with banks, because we speak with a lot of banks, the first question which banks have is, how do I do this legally? Okay? So KYC is one issue which is there, but it is not, KYC is not specific only to supply chain. KYC is pandemic to the entire SME financing bit. So if it's getting solved, and it is getting solved, slowly but surely across jurisdictions, it is getting solved. So we will reach there. However, whatever regulatory frameworks each country has, there's an opportunity of doing the deep tier piece within that. Because it's a question of looking at the glass as half empty or half full. So you can do deep tier in specific markets, even with the regulation that you already have.
Let me just add another lens to this, right? From a bank's perspective, I think the hardest part was really the governance aspect. I think don't confuse payable financing and DTSF. They are completely different. It's not that you can just take whatever principles we have in payable finance and copy and paste onto DTSF. I think it's I would say a different variant, but it's also very different product principles you have to adopt. And quite honestly, has taken us quite amount of sandboxing and POCs, and to really make sure that we understand the concepts and the risk associated with deep tier, with it to be able to deploy and scale. And that, I think, why there has taken so long for other banks to adopt is really that element. How do you ensure that, how do you get comfortable as an organization to adopt some of these key principles around legal, tax, compliance? You mentioned all the key themes. Those are not easy. And again, I'm keep coming back to that topic, right? 20 years ago, we were struggling with the same challenges. But I think what's clear, and what Sunil mentioned, the problem statement and the need is out there in the market. We see it every day, right?
Can I just delve a little bit, because I think the legal challenge is the core, right, to solving a lot of this. And I don't think a lot of the people in this room, certainly I don't, understand the sort of component bits that make up that legal problem. And could you just break that down for us? And then I'd like to pick up on some of the suggestions that I think you had for maybe all of us working to solve it.
Sorry, technical difficulties there. So I think what Aparna did mention was that at a certain level, at the first level, we have this concept known as a digital payment obligation. Now let's take away the digital aspect. Basically, you have a buyer that's committed to make payment. That's a concept I think anybody who deals with payable finance is really comfortable with. Now the question is then, how do you split it and transfer it? Right, that's a new concept that we have to grapple with. And it's a splitting of something that's sorted out in one court action at the first level is now split into several, possibly several court actions at a different level, different timing, different amounts. And then we think about the enforcement of that different timing, different amounts, in different countries, tying it back all the way up to one credit rating at the parent level or at the buyer level. That is the complexity that they were dealing with. Now, there are many ways evolving to resolve that. The most fundamental way is contractual terms. And that's pretty easy if we have what we call a closed system, where everybody is sitting on the same set of terms and conditions and agreeing to a particular mode of dispute resolution. And this is not something that trade hasn't done before. Everybody is on, well, a lot of financial institutions are on SWIFT, a common set of terms and conditions. When you look at platforms, we have a common playbook, common set of terms and conditions. We have UCP, common set of terms and conditions. It is just a matter of fine-tuning that concept to make it work. And the complexity, of course, is when you go into a trade transaction, which is cross-border, there are cross-border enforcement jurisdictional issues. Again, nothing we haven't resolved before with the New York Arbitration Convention or things like that.
Okay, thank you for that. So then, can we decide here now that we're going to, maybe through BAFT or through ICC or some other body that convenes people in the industry, that we're going to form a working group and do exactly what you're saying to resolve this legal problem? Is that I mean, there's no reason why we couldn't be able to do that, right?
Happy to do it.
Okay. All right. So Todd will be in touch, and anyone in the room who wants to participate in this working group, Angie, I assume you're in.
Yes, count me in.
Okay. So
Stephen, I have some questions from the audience on the app. Can I put them to your panel?
Yeah, sure.
Yeah, and we'll go through it fairly
I'm being corralled.
quick. Yeah, you're being cornered here now. No escape. Okay, I'm going to start. We have 5 questions. 2 of them are kind of the same, but I'm going to start with the easy one. And the easy one is, we are a multinational. It sounds very interesting, supporting the SMEs. I'm all for it. But what's in it for the multinationals? And I guess we're talking about a multinational in an advanced economy, I guess. That's the question.
What's in it for a large multinational
Yeah,
company?
yeah.
I think Michael is
Yeah,
primed to.
happy to speak.
They're not my questions. I'm just the messenger. Don't shoot me.
But then I want to come back because we're solving these problems, Vin.
Great.
It's a bit hard to know where the questions come from 360. No. I think there's a lot of benefits, right? We talked about sustainability, we talked about traceability, and having that transparent, very clear.
Yeah.
I think we ran a survey just when the pandemic started, and I think what was interesting is that the number of corporates that really understand their entire supply chain,
Yeah.
it really stops at tier one. It stops at, your key sort of tier one suppliers. They don't know what's beyond that, right? And I think that's, from our perspective, has been a key driver why corporates have been adopting this financing tool, because it creates that necessary visibility. They know where funding and financing is needed, and ultimately gives them that transparency and ultimately is sustainable.
I think that's a great answer. So moving
Sorry,
on.
can I just add to that?
Please.
It's also the robustness of the supply chain, right? Because if you know that your suppliers will have financing, it's going to be stable. It's not going to break through because somebody's going to go bankrupt.
Sounds good. Moving on to the second question, looking at the time. Great panel, great initiative. It would be wonderful. Are there any case studies that can be found, particularly in Africa, because it sounds like that's where this is really needed? Case studies? Plans?
None in Africa. None in Africa right now.
Where?
You have cases in China. There are a lot of cases in China.
Yeah. Most of our clients are now domestic China.
Okay.
We are looking to essentially expand into ASEAN. Africa is obviously part of our network, and we are looking at different experience there.
Wonderful. I guess it would be great to see the case studies on our next session. Next question, and they're getting a little bit tougher all the time, I think, okay? If a foreign supplier in an advanced economy is providing supply chain finance in this method to a local importer, is this financing at a cheaper rate, not competing with the local banks?
I don't think...
It's a good question.
I'm happy to take that. So, look, I think what we have realized, many years, it's not about the competitive element, it's about the complementary element, right?
Yeah.
And I think a local bank that is funded locally with local deposits is going to be far more cost-effective always than a more international bank, right?
Yeah.
So I think with deep tier financing, the next sort of iteration of this, how do you bring other FIs into this to provide the necessary funding, especially in the very long tail stuff?
That's wonderful, and I could see a role for the local banks providing maybe standby LCs covering these obligations. That's what I would like. Stephen, I know you want to comment.
Thanks, Vin. Yeah, we've got 8 minutes to try to resolve the second challenge. So the first one we've agreed, we're going to form a working group through BAF to solve the legal challenges that you've very clearly outlined, Angie. So on the tech, and Raj, I'm not sure I get this bit. So the paper said that the challenge is to completely integrate the tech platform with the buyer. Is that necessary? Is that required? So that's sort of one part of the question. If that's a problem, is that necessary? And the second part is, should we, to resolve this challenge to moving forward with the deep tier, should we contact the Digital Standards Initiative, which I think many people in the room know about, which we created with the International Chamber of Commerce and the Government of Singapore to come up with industry standards to drive interoperability? Should we ask the Digital Standards Initiative to take this on as a working group? So sort of those two parts.
Perfect. So there are two different parts. So the first part in terms of whether tech is required, yeah, tech is surely required, because you cannot do financing at the lower tiers until unless you have done their KYC, you have onboarded them. So that's a bare minimum essential which is there.
But does there have to be complete integration with the buyer's platform? Because my understanding was that was the part of the problem.
I think Raja, what he's mentioning is, does the tech platform have to be completely transparent to the lower tier suppliers? So they can go onto the company's ERP, for example, and they're not aware of who's playing what platform, etc. And in the normal course of business, it just goes on. So
you could embed the tech solution within the existing ERP. However, the challenge, as Michael pointed out, is most corporates do not have visibility beyond tier 1. So it's only in a few sectors, like maybe the auto sector or the electronic sector, where you have visibility beyond the tier 1 level at the corporate level. Otherwise, corporates don't have visibility. So you cannot actually even embed a tech solution into their ERP and get away with it. So to answer the question, if you want to do deep tier as a bank, as a lender, you will have to onboard your multiple tiers. That's one. When it comes to the second part, which is interoperability, having a working group very similar to what we spoke about for the legal aspect would make a lot of sense, because there are two parts to deep tier again. One is the international supply chains, one is the domestic supply chains. Domestic supply chains do not require the interoperability. The international ones will require interoperability. So that's the way the banks will have to think of it. And you're getting a mass or somebody to take forward using the digital initiatives, maybe a way to do work on the interoperability for the international supply chains.
Okay, good. Thanks, Rajat. Well, then we'll take that on, huh, Sanu? We'll get a group going and we'll take that on. Todd, any thoughts? You're giving me that look.
I'm thinking, in addition to the legal challenges, and I know you mentioned KYC is solvable, I think it's potentially a bigger challenge for us to solve, because there's a cultural issue at two levels. One at the regulatory level, and then one within the institution itself, right? So I think of it very similar, and it's probably a bad analogy, but you have money service businesses and payment service providers that are filling a last mile role in the payment space in many cases. But then it becomes a problem if they ultimately need to clear through larger banks who are held to a certain regulatory standard that may be different than the payment service provider, right? So ultimately, the banks are acting as regulators, even though they don't necessarily have that role at the lowest end of the customer level. When we start talking about onboarding tier 2, tier 3 suppliers, I can't help but think at some point in time, the regulators are going to have some serious conversations with the banks about their rigor around onboarding tier 2, tier 3 suppliers. And then by extension, the compliance organizations, credit risk organizations are going to have those same concerns. So I do think we have to tackle that. It's not insurmountable, but we shouldn't underestimate it.
Yeah, that's a good point. And maybe in the process, as we go through this journey with the working groups on the legal and the tech, we need to bring in the regulators to make sure that they're abreast of what it is that we're doing, and see if we need to make any sort of jigs or tweaks along the way. Anything else? Any other thoughts? No? I think, okay, we've got one more question. Thank you.
Thank you, but before you go, we have one more question. And it's we are a large financial institution operating in emerging markets. A great initiative, a great panel, very, very clear. But if we are to take on deep tier corporates in emerging markets, Todd, I think this is following on your point, we're taking on an extra compliance challenge which is already overwhelming. I think this is following off from your point. Any comment? Or?
Speak to us, we connect.
Yeah.
No, yeah. I think that's really where the opportunity is, right? It's not about these domestic supply chains. It's about the corridors and how we connect large buyers in Europe or the US into Asia supply chains, right? And that's exactly what we're working on. And I don't think we can solve this ourselves. There is a need for collaboration, right? So
great,
absolutely.
Great, and the questioner told me not to mention his name, but I have no idea what your name is. It just comes in on the WhatsApp from Jeff to me, so I have no idea. But he made another comment, and that comment is we need to find a structure where the corporate multinational can take the compliance risk and we do the financing. So that's kind of interesting as well. So everybody, could we give a big round of applause to this wonderful panel? Stephen, great job.
Thanks very much, guys.
Really wonderful.